Hello and welcome to the look ahead for Wednesday, the 17th of July, with me, Fiona Cincotta, Senior Market Analyst at City Index. So, in the European session, we will be watching UK inflation data. There's also inflation data from the Eurozone, although this is the second reading for June. Got US with building permits, industrial output, and the beige book, as well as oil inventories. So, as far as UK inflation is concerned, we're going to be expecting to see inflation potentially cool to 1.9%. So that would be below the Bank of England's target 2% level. However, we've heard from Bank of England speakers recently who have sounded still concerned about sticky level of service sector inflation and high wage growth, which are still both towards the 6% level. So the Bank of England policymakers are going to want to see those figures, the service sector inflation data, cooling ahead of wage growth, which will come in on Thursday. Now, as far as expectations for rate cuts are concerned, the market is actually less expected, sort of pricing in less probability now of a rate cut in September than it was just a few weeks ago. And that's basically because we've had that stronger than expected UK GDP data last week. We've also had some hawkish commentary from Bank of England policy makers who suggested that service sector inflation and wage growth were still too high. As a result of that, and the weakening that we've seen in the US dollar as the Federal Reserve hint more towards a September rate hike, we've seen that the pound US dollar has risen to its highest level this year. Now, as far as Bank of England rate cut expectations are concerned, the market is pricing in around 25 basis point rate cuts this year, potentially with the first one in September. That's just below a 50% expectation of a rate cut in September. However, the Federal Reserve, the market is expecting to cut by 25 basis points in September. So after we've seen inflation cool, we've had from Federal Reserve Chair Jerome Powell, who sounded a little bit more dovish in his commentary, and a bit more confident that inflation was cooling towards the central bank's 2% target. And that's made the market convinced that the Fed is actually going to cut as soon as September. So as a result, we've seen the pound US dollar has risen higher. So we're just having a look at it now. It went up to, it recovered from, technically this low back here in April 2024, we've seen it trading within this rising channel, just recently topping the channel there at 130, or just under 130 in fact, and it's just easing back down from that level. So if we get cooler than expected inflation, more specifically cooler than expected service sector inflation, then we could really see this is the level to be watching here. At the 128 level, and 129 level, and if that was the high that was seen back in March, and if we get a breakthrough there, then you need to be watching out for the 128 level. If we get hotter than expected inflation, then that could actually see this 130 level taken out. So, the US dollar, as I said, it has had a weaker run recently after we sort of softer than expected data, cooling inflation, and dovish Fed commentary have just pulled it, have helped it, the US dollar fall lower. So what we'll be looking at for tomorrow, as I said, service sector inflation, particularly in focus. Just also looking to euro US dollar, because we do have inflation data out from the Eurozone as well. Although, as I said, this is the second reading, so it's not necessarily going to be that market moving, only if there's a very big revision either upwards or downwards. Now, again, we can see how the euro has capitalized on that weaker US dollar, recovering from the 106.70 level all the way up to 109.15, which is where it's just come off now. That was a high that we saw in June. Now, if we get sort of cooler than expected inflation data, a downward revision, then we could see the euro come under further pressure, bringing the 200 SMA into play at 107.90. If we get an upward revision to inflation, then maybe we'll see it push above that 109 level of 109.15. If we get above 109.15, watch out for 109.80, which is the March high. Obviously, the inflation data for the Eurozone comes ahead of the ECB interest rate decision, which is later on Thursday, later this week. The ECB is not expected to cut interest rates, but it could potentially prepare the market for a cut in September. Other items just to be watching. I think we've talked about, we've got some US data coming out tomorrow, but I mean, just worth having, keeping an eye on gold as it's attempting to break out of this above the all-time high to fresh all-time high. It's currently trading at the moment at a new all-time high. It's taken out the 2450 level, which we saw in May. And I mean, the next logical target will be 2500. The breakout in gold has come as we've seen the Federal Reserve, as I said, adopt a more dovish tone, and we've seen that inflation data cool. The gold is potentially is looking to break out there. On the downside, the support can be seen here at around the 2380 level. Also worth just looking at when we're talking about US, we've got, as I said, some US data. It's just, it's not high impacting US data, it's medium impacting US data, so not potentially that market moving. But look, we've seen a rise here in Wall Street. I mean, we had retail sales data come in today. The market has brushed those aside, given that they were the strongest. Retail sales ex cars was the strongest it's been for 3 months. Doesn't seem to have deterred Wall Street traders, with the Dow Jones at an all-time high and well into overbought territory. So just be wary. Support on this one can be seen at just above the 40,000 level, so 40,080, which was the high back in May. If we keep getting slight weakness in data and expectations that the Fed will cut rates as soon as September, then potentially a rise above that 41,000 could be happening sooner rather than later. Also, let's just take a look at oil, as we've got those oil inventories. Now, it's quite interesting because although we've had this sort of increased expectations that the Federal Reserve is going to be cutting interest rates soon, which is good news for oil, because lower interest rate environment is supportive growth, which is good for oil prices. However, at the same time, we've got concerns over the health of the Chinese economy, which really aren't going anywhere fast. China's GDP came in below expectations at 4.7%. We sparked a sell-off in oil prices, which has continued today. It's just testing here around the 80.50 level, which is also the late May high. Right, it is the May high, full stop. No, it's not. It's the late May high. So if we get a breakthrough there and the 200 SMA at 78.79, then that could spark a sell-off towards that 77.70 level. If this holds, if we find that perhaps there's a bigger draw than expected of inventory data, then we might see a recovery back up to this level here, which is the 84.50. That's the level that buyers will need to take out in order to create a higher high. So I do hope that you like what you've seen. And if you do, then please do give this video a like. And if you'd like to receive more like it, then please do subscribe.